Welcome to our weekly show focusing on the key macro trends affecting FX and the broader market. Today we're going to be looking at copper and the Aussie dollar. Now in recent weeks we've seen copper prices pushing back towards their all-time highs. Now the longer-term bull case for copper has been well flagged. Electrification requires significant upgrades to networks and infrastructure, and copper is at the core of that process. And yet despite this, the whole mining sector has suffered underinvestment for much of the last decade. Now please remember that none of this is investment advice. It's for education and engagement purposes only. When investing, understand your own risk tolerance, time horizon, and investment objectives. And then invest accordingly. More recently, copper has been overshadowed by the performance of gold and silver, both of which have outperformed over the last few years. But despite this impressive environment for metal commodities, the commodity currencies, like the Australian dollar, have lagged this underlying performance. In fact, for most of the last 25 years, the Aussie dollar and the price of copper have generally moved in lockstep. Over the last 5 years, however, the paths of copper and the Aussie dollar have significantly diverged. The reasons are largely due to the changing nature of global demand. Commodity currencies and the global mining stocks had benefited from both rising volume and rising price, particularly during China's phase of growth at any price from around 2000 to 2015. But since 2020, the nature of China's demand has shifted. The demand is still high, but the rate of change has shifted down a gear as policymakers refocus their efforts on consumption and sustainability rather than urban infrastructure. So where does this leave the commodity currencies? High commodity prices are still supportive, but it's a broader US dollar dynamic that's been in the driving seat. We can see that the broader based emerging market currency index has also been in a lengthy downward trend versus the US dollar. The Aussie dollar has marginally outperformed, but it's clear that a bigger global dynamic is at work. Investors who like the commodity complex have continued to show a preference for the underlying metals, and now, increasingly, mining equities like the XME ETF, which is building some momentum. The metals and miners should therefore continue to be better expressions of the commodity theme than commodity currencies like the Aussie, even when adjusted for volatility. And with that, now let's have a look at some of the questions we've received this week. First up is, will the Bank of Japan hike interest rates at their December meeting? Well, for now, the focus has currently turned to the upcoming US Federal Reserve meeting, or FOMC, on the 9th and 10th of December. For global investors, however, the Bank of Japan on the 18th and 19th of December may be more important. Now, they're expected to hike rates because inflation remains at the top end of the 40-year range. And many economists are arguing that Japan is now undergoing a generational shift from a declining rate environment to a long-term rising rate environment. And Japan's 10-year yields could be about to break to a 25-year high. In fact, the Bank of Japan may even signal more hikes are to come in 2026. The next question is, are the risks increasing that gold prices could collapse? Well, the gold price currently has many structural supports. Central banks have been diversifying away from US Treasuries towards gold to reduce their reliance on dollar instruments. And furthermore, gold is still considered to be a store of value in a global environment of rising government debt and currency debasement. And we can see that the gold rally is even more emphatic when placed in other currencies like the Japanese yen. So whilst gold prices are stretched with many late arrivals to the market, the longer term themes supporting the gold price do remain unchanged. And our final question is, will the current Chinese equity market rally become a bull market? Well, we've been here before. The Chinese equity market has rallied many times in the last 25 years, only to roll over and disappoint investors. In fact, we're only a few months out of a 4-year bear market. So could this time be different? Which are very famous last words indeed. What could have changed? As we've already seen, China has moved away from an all-out growth strategy to one that aims for sustainable growth centred around demand and domestic consumption. And much of the pain of the last few years was part of that realignment of resources, as well as the aftermath of the drastic response to COVID in 2020. Today, China's economy has been redirected towards a longer-term resilience focused on new technology via volume and value. Rather than competing with the Nvidias of the world, the aim is to provide affordability for a mass market. Now, understandably, investors will remain wary of the credit and debt overhang. But today's economy and markets are being built for resilience. Investors have therefore preferred to focus on those sectors where China has taken a lead, like electrification and driverless cars. And as you all know, investing is rarely smooth. But China's leaders have indicated that they would like the extreme swings of the economy and the market to now be a thing of the past.